Hi, this is Yahoo, macro option trader. Today is Sunday, May 10th, 2026, 10:09 a.m. The Nikkei is showing tremendous strength right now, so instead of simply reviewing the market, I'd rather talk about the structure behind what's happening. Recently, I've been thinking a lot about one question. In an era of currency debasement, what becomes the strongest asset? Traditionally, the answer was gold. Governments print money, inflation rises, currency value declines, so people buy gold. A relatively simple structure. But what's happening now is not just inflation. It is an explosion in productivity drive by AI. Human labor is gradually being replaced by computational resources. Normally, productivity expressions are deflationary. AI loads cost. Labor becomes cheaper, service becomes cheaper. And yet, stock indexes continue to rise. That is an important part. Today's indexes are no longer simply the average economy. In the past, indexes were diversified across banks, railroads, automakers, trading firms, and many industries. But now it's different. AI, semiconductors, cloud infrastructure, data centers, computational resources. In other words, the core companies of AI civilization are beginning to dominate as index. As a result, the index themselves are become AI index. That may mean modern indexes are become more resistant to currency debasement than even gold itself. Because the more liquidity exists, the more capital AI companies can absorb. This is extremely important. Gold used to represent store of value, but AI index represent absorption of value. They absorb global liquidity, productivity, expectations, and capital flows continually expanding. So today's market is increasingly become a structure of column by AI individual stocks or by index calls, especially in Nasdaq-related markets. And from an options perspective, this structure is also extremely dangerous. Because rising indices attract more passive inflows, which increase AI weightings further, which then pushes indices even higher. A self-reinforcing cycle. Index buying down AI stock, appreciation down higher index weight. In down ETF inflows down further, index appreciation that's the root. Which is why the market no longer feels driven purely by PEROIPS. It feels driven by complexity. From an options perspective, it almost feels like Colgan itself is pushing the market apart. Then the question becomes, what could actually break this market? That's the difficult part. In the past, recessions or wars could do it. But today, simple economic weakness may not be enough. Because the weaker the economy becomes, the stronger expectations for AI and automation may become. The post-COVID Nasdaq rally symbolized this perfectly. Modern pandemics themselves may become AI acceleration events. So recently, I've been thinking that the true vulnerability may not be AI itself, but rather the systems supporting AI. For example, data center, finance, electricity, private credit, GPU, REITs, infrastructure finance, DAS areas. The world is currently making enormous investments based on AI expectations. But underneath that, there may also be enormous credit expansion. Which means the true danger may not be disappointing AI earnings. The real danger may be the moment when markets realize there is not enough cash. Because ultimately, index crashes are really about surging demand for liquidity. During crashes, gold gets sold, Bitcoin gets sold, even quality equities get sold. Because everyone wants cash. That is why the next major crash may begin not from AI corrupts itself, but from private credit and other financial markets. Or perhaps from the physical infrastructure supporting AI civilization itself. Electricity, sovereign debt, credit markets, government finances. Those may be the true risks. Which means today's stock indexes no longer just stock index. They are become expectations on humanity's computation future itself. So with that, today's episode comes to an end. Please follow my contents the way you would hold a long put position. See you tomorrow.